Hello, everybody. This is True Demon, the Devil's Stockbroker, bringing you another live update and live stream on the market and our ongoing predictions for a coming market crash, which now seems to be in full swing. We've got a little bit of a retracement, just kind of a dead cat bounce, is what I would call it. The market is a dead cat. We'll also be talking about some of our other squeeze picks, some bear plays that we'll be looking at, and what's going on with some of the existing plays in the market right now. Currently on my screen, I've got, actually, before I begin, let me just remind everybody that none of what I say on this channel is financial advice. I'm not a financial advisor. I'm just a YouTuber, and all I'm doing is just trying to share some amateur day trading, swing trading knowledge and experience, and share some ideas with everybody in the market. And with that being said, let's go ahead and cover some due diligence on the market. So right now, before going further, I would like to ask everybody, please, if you haven't already, please give the video a like, make YouTube's algorithm happy with us, and share the video on Twitter if you can, or elsewhere, wherever you can find a crowd, and that'll help bring people in so that they can get informed as well. Okay. While we're waiting for people to trickle in, how's everybody doing?
No, it's one of those days. There's a lot going on and not a lot at the same time.
Yeah.
A lot of setups and a lot of sideways.
There is a lot of setups and a lot of sideways. The market overall is still heading down. It's following this this channel that I drew. It bounced out of it with this rally, and I knew that if it couldn't hold up above 420, that it wasn't going to go any further than that, and it was going to come down hard. I didn't quite expect it to be this hard, but I just SPXX calls and DRV calls were absolutely the way to go. I think those positions combined are up. They're each up like over 120% profit, and I only went slightly out of the money on those. Let's see. How's the stream, guys? Let me know how it is, if it's actually coming through nice and clear. I feel like my computer is running at snail's pace right now.
The stream looks good.
Okay, good. I'm trying to close a few things just to give it a little bit more life. I think it's Firefox, to be honest with you. Firefox, for whatever reason, is just way slower. But whatever. Okay. So while we're looking at the SPY, let's talk about the market and start to talk about what's going on with the Fed meeting. So currently the Fed is calling an emergency FOMC meeting. The meeting is going to be to cover how they're going to address inflation, and clearly inflation is still out of control. So if I bring up the U.S. inflation year over year, where is it? Why are you hiding from me? Oh, I see, because I'm on a sub-daily time frame. Okay. So here's here's inflation at 8.3. It's barely been touched. We were at a high of 7.9 year over year, and we've been holding at 8.5. And it only just barely went down to 8.3%. So inflation is sky high right now, and the reality of the situation is so much worse because, as I have been talking about on the channel, the government is not incentivized to actually tell us the truth about inflation for multiple reasons. And if you didn't already check out the video that I had tweeted out before, I'll see if I can go ahead and pull it up for you again. But there was a tax professional on YouTube that was calling out his reasons for why the government is not telling the whole truth about inflation. For starters, the CPI index which is the way that we track inflation, it's considerably ineffective at actually tracking inflation, and there's multiple reasons why it actually is designed in such a way that it tells as little bit of the truth as possible, and it gives them multiple ways to fudge the reality of it. They do this by measuring prices against things like the price of sugar, for example. Like they track inflation by the price of sugar. As it turns out, the CPI index is able to fudge the numbers a little bit by finding a quote substitute. So if they find a substitute so if you have sugar that's been raised by $1, but you find stevia, a sugar alternative that has only been raised by like 6 cents, they'll use that number. They'll use the number for stevia instead. And that's just one example. If you find alternative fuels for gasoline, they say ethanol-based fuels are more expensive than just traditional unleaded gas. They'll use the price for the unleaded gas because it is a quote substitute. So this concept of being able to adjust the inflation numbers based on substitute figures rather than taking a median or an average for them gives them the ability to choose the lowest number in the range for different factors that affect our inflation. And that's where this shit gets truly off the wall sketchy. So I'm going to go ahead and share this link to this video for everybody to check out on their own time. It's pinned to the chat. Strongly recommend that people that don't understand inflation or don't understand what the incentives are for why inflation is not being accurately reported, please take a look at that video. It's extremely good. I don't know the guy. I'm not like endorsing his channel or anything, but I'm just objectively, or I guess it's my opinion. So subjectively, my opinion, that guy explains it very well in a nice, concise way that anybody can truly understand why the government's numbers and reports for the CPI index are inaccurate. But the other half of it is that the higher inflation is, the higher the interest rates will need to be risen. And the higher the interest rates need to be risen by the Fed, the more interest the government will have to pay on its debt. And that's where we get into this true crisis that we're experiencing right now. Right now, the market is tanking right now because of inflation fears, because the market knows that if we have to raise rates, then that's going to cause money to leave the market. They're going to move it into commodities and things that are protected against inflation. So the stock market, companies, growth companies, tech sector, it's all going to be hurt by this. And they'll move that money into places where they believe that there will be a hedge for it. The problem is that on the other side of it, if the government doesn't raise rates in order to allow the stock market to keep ripping, which it's not able to anymore, the fear has settled in. So it's too late. But if they don't address the inflation, then they're going to have to continuously pay this hyperinflated debt. They're going to be basically just kicking the can down the road one more time, and eventually it will be impossible. It may already be impossible to pay down our debt, and it may already be too late to stop inflation. But unless they do something drastic right now, the crisis will swallow us because not dealing with it is far worse than the consequences of having to take drastic action now. I had a officer in my unit when I was in the Army that told me once that a terrible decision made now is better than the perfect plan made too late.
I like that.
Yeah, I think that was it was some general or some officer from It may have been Patton. I don't know, but you can look it up. But anyway, I really like that quote because it's a matter of being decisive. You have to take decisive actions in matters of crisis, and waiting too long trying to make the perfect plan or trying to overthink the problem is not going to save you. It's going to waste time. And right now, we are wasting so much time. The Fed is now meeting to discuss what the hell they're going to do about this. Because if this inflation problem continues, it's going to continue to hurt the consumer. And we can prove this by checking at the Consumer Confidence Index. Which is at an all-time low. It actually hasn't been this low since 2008. This is the lowest. It's lower than its lowest point in November of 2008 during the worst of the market crash. This was after the worst of the market crash in 2008. Our consumer confidence index has fallen through that level. That is really saying something. And let's take it a step further by measuring a few other factors against this as well. Let me go ahead and take this out of your way so that you guys don't have to stare at that big ugly table. Personal savings measured by the Bureau of Economics measures the average savings account of Americans, and it is now at its lowest level since, would you look at that, 2008. So after the worst of 2008, and even in the midst of the recovery period, our personal savings of average Americans is at its lowest point. And that's very dangerous, because if consumer confidence is at an all-time low, if people are having to pay more through inflation, which is basically just a tax because it dilutes the buying power of average Americans, it dilutes the power of our currency, it's going to continuously hurt our buying power, and people are already running out of money because they're having to pay more for common goods just to live. It's become so much more expensive to live. Rates for rent, basic necessities like gasoline, oil, food, wheat, cereal, meat, everything is just so prohibitively expensive now. People are going to have no choice but to go and find other ways in order to live. And this crisis is going to eventually bring people to a breaking point. And I don't mean a breaking point like people will just go in default and go into bankruptcy. No, people will get angry because if you are not able to provide people with the ability to have access to common goods, like you're talking about a French Revolution scenario, and Marie Antoinette, I don't think she really said this, but the let them eat bread. That's the situation that you're talking about. So if we continue down this path of not dealing with the inflation problem, then it's going to bite us in the ass in a big way. We're already in deep trouble right now. So this market has to crash. It has to crash for the greater good. It's the way it is. So in order for people to protect themselves, I feel like it's important to call out the current situation that we're in, be perfectly brutally honest about it, and just remind everyone that we are in a bubble and it is popped. And now the bottom is about to fall out on us. We just have to acknowledge it. Okay? Hoot is interviewing GMVD CEO live. Oh, wow. I had heard about, so interestingly enough, I looked at Hoot Money's due diligence on it. I don't normally agree with Hoot Money's analysis on some things. He gets pretty excited about some stuff, but that's just his trading style. If that's what he If that's how he trades, that's fine. But I looked at the numbers and just, in my opinion, I think he's right. The short exempts on GMVD are excessive. We'll talk about that a little bit later, but at the moment, I just want to wrap up some thoughts on the current state of the market. So while we're talking about this, right now the market is it's basically finding its latest support before it breaks down completely. We're in a really bad situation, and everybody who is currently in the market, please understand that this is not financial advice, but please also really carefully consider what I am about to tell you. If you are in this market and you are invested heavily into ETFs, indexes, mutual funds, and bonds, you are in trouble. You are betting on a market that is severely against you in an environment that is unfriendly to the American dollar. There are many circumstances which are fighting our ability and our buying power to hold this market up. The market is over-leveraged as it is. Margin debt is at an all-time high. Personal savings of average Americans and the Consumer Confidence Index is at an all-time low. The Consumer Price Index and inflation is at its highest levels since the 1970s. It is excessively high because we pumped too much money into the system, and now it is going to come back to bite us. There is no scenario where the market continue going up and simultaneously the dollar survives. Ultimately, the government will choose to let the stock market collapse rather than the collapse of the entire currency altogether. They have to do this. So any bull rally that you see, it's bullshit. Anytime that you see the market rip up from these lower lows is only temporary. We have a long way to go. We have only barely started raising interest rates. I don't think the Fed's been aggressive enough. They've only been raising it by 50 basis points. And most recently, Chairman Powell, the chairman of the Federal Reserve, has been talking about how much he admires Volcker, Paul Volcker, the Volcker who raised interest rates in the 1970s to a whopping 20%. People were paying 18% on mortgage payments. It was a bad time, and it was necessary to get the inflation under control. But we really need to acknowledge the gravity of when the Fed chair starts talking like that. So let's go ahead and review the levels that I have mapped out, and I'll let you guys know what's up. So I'll hide this stuff again, and we'll look at this on a weekly time frame. Try to make this a little easier to see. So I had marked out these areas where institutions would be selling heavily in order to get out of their bags. I said that 430 was the absolute highest level that I could see it reasonably reaching, but I didn't think it would get much farther above 415. And that played out. That was true. You have this big you have a big green candle from a bear rally that occurred. It hit like 416 plus change, and then started to retrace the very next 2 weeks. We were consolidating at that level. Institutions were unloading the bags. Now we have the real weight of the market coming down. I have marked out 380 as a significant level of support before it falls into what I'm calling the panic zone. Let me go ahead and get rid of my Fibonacci's. So we are below this level of support now. How do I know that this is a massive level of support? I used volume profiles. I was looking for areas where a lot of trading had occurred above and below. The most trading that took place was during the COVID pandemic and before, as well as mid-crash. Almost all of the trading took place between $275 and $300 on the indices. So this is what we can reasonably assume is our level of support. But also remember that this is the time when the Fed started pumping a bunch of money into the system, and we were overdue for a correction at that time already. So the Fed printing money actually exacerbated the problem that we are now going through. And going back all the way to 2013 brings our support all the way down here to these levels. 2014 through 2015 is where we spent the most of our time trading at around the $200 price level. So if we continue to crash through these levels, it is possible that we can go as far as 200 on the SPY. That's just my opinion. I'm not saying that's a likely scenario, but I'm saying it's possible. And I think that if it reaches that level, that is where the bottom will be, unless the market totally goes into full-blown panic, and at that point we're looking at another depression on the scale that we saw in 1929. But after reviewing all of this, we are clearly breaking down into the panic zone. This is the point where there's very little volume traded, and this is where the SPY had its largest movement in a short period of time. And remember that fear and panic are a more powerful human emotion than euphoria and happiness. People that were buying in these areas, they still had that resistance to buying. People that did buy and that are stuck here at the top are now going to truly begin to feel the pain of what they have lost, and there's no volume down here. So when this price starts to fall, it's going to fall hard, and I think it's going to come when the Fed meeting comes out and when the Fed comes out and announces a 100 basis point hike. Some people are talking a 75 basis point, but I think he may go as high as a full 1% increase on the interest rates. And if he does that, it will be worse than the market expects. This priced in correction that we're seeing here is not going to, it's going to get much worse. That's just my opinion. And I do think it's necessary for this to occur in order to save us from this situation that we've put ourselves in. But it is going to be a really painful experience. So if you're looking to hedge yourself, calls on DRV, which is it's a leveraged ETF that bets against the housing market. So whatever the housing market is doing, this does 3 times the opposite. And if you compare this to XLRE, which is the SPDR index's real estate ETF, you see that this is going way, way down. The housing market has still yet to collapse. It's only just now correcting, and the supply is catching up. So this is going to get worse. So you can buy puts on this thing, or you can do calls on DRV. I did both. You can make your own decision about what you'd like to do, but those are just a couple of ways that I set myself up for this particular play.
For those calls and puts, how far out are you looking, TD?
Well, there's a heavy amount of drift on DRV, so if you're looking to go for a long-term crash, it's better to buy like leap puts on XLRE, because those don't decay in value quite as quickly as DRV. DRV is for catching those very rapid spikes because there's drift. It's because this particular ETF gets its leverage from swaps. So what happens is if the market does nothing, if it goes sideways, this goes down. And if the market goes down, it goes down harder. Or if the real estate market goes up, I should say, this goes down harder. So if the real estate market goes up 10%, then this can fall as far as 30%. So those corrections can happen very quickly, but generally this is for catching those rapid ascensions. So if you're paying attention closely to the data, and you can see those indications like inventory rising, or listing prices rapidly declining, or if you're seeing lending standards are starting to depreciate, or if people are not able to qualify for their lending, then you take that as a sign. Like say that like a whole bunch of people defaulted on their homes and a bunch of foreclosure data come out, this I guarantee you would go flying. But you have to time it right. See, I had bought some calls around here at 50, and they were for June. They went down to I bought them for 500. They were down to as low as $100 each, and just now they're up they're up 10 times their original value. So you have to be careful. You can lose a lot really quickly, but you can get a lot really quickly. So this is one where you're like really trying to time it on a monthly time frame. If you want to just bet against the housing market or the real estate market or just the broader market overall, you're better off buying puts against that ETF specifically. If you want to catch these big waves, you buy calls on it for a month or 2 months away. Another thing that I'm doing is betting against all the major banks, which my Bank of America puts are printing. I didn't get a position against Wells Fargo, but this is another one that you could do. Puts against Wells Fargo did really well. They are actually going through a major investigation for their hiring practices, but they're also, a lot of people don't know this, Wells Fargo is holding most of the debt for forbeared loans and mortgages. Let's see. Scrap Queen, I'm listening to your or I'm reading through your stuff right now. Oh boy. I think I have a news article to go back and read in a second. Can you touch on what happens as we raise the interest rates and how that impacts our national debt and the amount of interest payments required to be paid on it? Yeah, so when the government raises interest rate on debt, it also raises their own interest rates on the debt that they need to pay. Essentially, it causes the banks to it causes the banks to tighten up their budgets because the lending from the government is much more expensive, and it also increases the rate at which the government itself needs to pay back the national debt. So interest is a double-edged sword. It tightens up the money in the country, but it also tightens up the money in the national budget. So by raising those interest rates, it's not just causing pain for the market and for the average consumer, it's also causing pain for the government. And it's going to reduce the amount of buying power and the accessibility to the budget that the market or that the government itself has for, their regular usage of it. So that has a pretty pronounced effect on their ability to make, bureaucratic decisions or political decisions. And it's going to reduce the ability of the government to, pay for social programs or pay for the infrastructure bill, things of that nature. So all of that is going to tighten up things for the president and for local governments as well, and it's going to make it harder for them to get things done. And eventually that pain is going to be too much for them, and it's possible the president may just step in and tell the Fed, like, okay, you need to cut it out with the interest rates. But in my opinion, I don't think they're going to. I think they're going to let the Fed make the tough decisions because they understand, at least they are beginning to understand what is on the other side of this if they don't deal with the problem now. This is the final, I really believe that this is our final chance to get our debt under control. If we don't get the debt under control, if we don't crash the market, and if we don't get the interest rates, if we don't raise the interest rates to get inflation under control, it is absolutely going to crush our dollar. It's going to ruin our currency. Do I think that we go back and fill the gaps on SPY? No, I don't. No, I don't. I don't think we will. We may fill the first gap, maybe, but if we get like the highest I see it going back to is 385 and then immediate rejection at most. That's where I think we're currently at. if I were to take a volume profile of this and just look at the most recent time frame, let me zoom this in here. You see that most of the trading that happened here was at 416. This was almost all selling. Tons and tons and tons of selling. This is where I feel the institutions were unloading their bags on retail investors, trying to get us to hold on to whatever they could dump onto us, and then they collapsed the market out from underneath us. They pulled the rug. Now, the news from the Fed meeting had a lot to do with this, but this move here, I truly feel was honestly a false flag operation by mainstream media and Wall Street to try and get people to come into the market for one last time, give them one last opportunity to unload all of their heavy bags that they know are going to collapse in value. We may be seeing another situation where major banks in the United States begin to fail. And this time we do not need to give them another bailout. At this point, the government has to step in and take over, because if they don't, then these banks will continue to run rampant, abusing their position and taking advantage of the government in order to make profit by any means necessary, and that includes fraud. But to answer your question for the for the fourth or fifth time, I think that the highest we see is 385 and then rejection. I don't think we're going back. This is the point where we need to be looking for consolidation to the side, market moving to the right and nowhere, and getting ready for the big one. You think that these moves were bad, the last one will be far worse. Comparing this to 2008, this is perfectly on track, except 2008 took 2 years to play out from the top to the bottom. This, I think, will take half that time, maybe a few months. But this is going to come down further. Stop saying government. It's our money. Government doesn't produce anything. Yeah, you're not wrong. It's taxpayer money. It is taxpayer money. Oh boy. So this was the news that was just sent to me by Tempestuous Persephone. Real estate firms Compass and Redfin announced layoffs as the housing market slows. This is what I was afraid of. In filings with the SEC, Compass announced a 10% cut to its workforce, and Redfin announced an 8% cut. Mortgage rates have taken off since the start of the year, rising from 3.29% in early January to 6.28% now. Home sales have been dropping for several straight months, and the fall is expected to worsen. I've been tracking this data and getting some help from the Discord, and there has been a rapid ascension in the amount of listings, repeated price cuts to homes, and all of that has been accelerating. I've been talking about this for weeks. A lot of people out in social media, in all of the overheated markets, have been saying, no, it's going up forever. And I'm like, you're so full of shit. Don't fall for that bullshit. This is perhaps this may perhaps be one of our last opportunities to really prepare ourselves for a true housing crash. This is the beginning. In about 6 months, there is going to be a huge wave of foreclosures. The foreclosures for Texas are only now just starting to hit. By March of next year, the foreclosures for Idaho will be hitting. And Idaho is the most overvalued market in the United States. And people are starting to lose their asses on all of their houses. The equity in all of the homes that they bought for cash is drying up. There's no equity left. Anybody that bought with a mortgage, especially if they got an adjustable rate mortgage, is going to be screwed. And those will reset after a year. So all of these factors there's a very long wait period for this to happen, but all of the overvalued markets, Texas, Florida, Idaho, Washington, California, they're all getting hurt. The foreclosures will have to wait for a while, but when those hit, that's when things truly get bad for the housing market. Falling from $97 per share to $8. Yeah, man. Redfin's in bad shape. This was called out to me by one of the users of the Discord a couple days ago on YouTube. And yeah, this was a pretty bad fall. I was expecting this to keep going. Man, $97 from February of last year, a 92% decline over the course of a year and a half. That's just insane. Yeah, mortgage company layoffs are coming out from everywhere. Thanks, Todd, for bringing that up. And mortgage companies, Wells Fargo, 2 months ago, they had already laid off all their they laid off more than 30% of their mortgage origination staff. That means that they were expecting a massive decline in mortgage originations, so people not going in to buy a home and needing to get a loan. And they're cutting staff. Like, everybody's cutting staff. Bank of America is still spewing bullshit saying that, oh, we're seeing healthy loan growth, and for whatever reason, they think that that's a good sign that the recession isn't going to happen. They're so far in denial. Kramer is the false flag giveaway. Oh, man. When am I going to start buying? That's a tough question. I'm going to start buying once I see the market crash. I'm going to start buying once it's already fallen through the floor. Like I said, the SPY is going to come down. I will give you an indicator that I feel is extremely helpful. There's this indicator on. Let's see. I think this is it. The golden ratio fib indicator. Here we go. So the golden ratio Fibonacci indicator is kind of a waveform indicator that shows you the fib levels over a moving average time period. So for the most part, it moves with the trend, but you'll see these moments where it rapidly like major crashes, big crash events, whenever they cross or approach these fib levels, that is a buying signal. So one way that you could do that is by using this golden ratio tool. And if you went all the way back to, say, if you went all the way back to 2008, for example, you would see this here, right here. You could do it in the dot-com era too. See the dot-com boom, when that bust occurred, it bounced off of these golden ratio fib levels. The 2008 crash went through 2 levels and then went on a massive recovery, but that was the bottom. So you could use these fib levels in order to pick your bottom. So we've been moving up for a long time, and if you notice that my absolute max bottom, I didn't come up with this out of thin air, but I didn't even use these golden ratios to find this level. And look at where my line showed up compared to the fib levels. If this thing breaks through the next 2 fib levels, then I would expect it to stop here or here, and that would be right at my absolute max bottom. So if I see the SPY breaking down at $200, whatever company survives, then I'll go for that. There are some companies that I am buying right now, like Ollie's Bargain Outlets. Ollie's Bargain Outlet, I feel, is going to do extremely well in the coming inflationary environment because they have access to very cheap goods. But I would trade that as like very, It doesn't. It's not guaranteed that they will do well, but I think that out of all of the companies that are likely to do well in the crash, I feel like they will do the best. It doesn't mean that they will go like bananas, but I kind of feel like they will. It's kind of a feeling. It's a little bit of a trust me, bro, but Ollie's Bargain Outlet, I mean, they have a lot going for them. They have access to some of the cheapest goods, and Walmart and Target are giving up market share, and they're having to dump product, which that's what these guys buy. They buy all the product that the other companies can't sell, and they get it so dirt cheap that they can give a huge discount on it and still make a 40% profit. And if they can get that, if they can achieve those levels, then yeah, this company can absolutely make stupid money. And besides that, like after their IPO, they ripped to coming out of their IPO at $20, they ripped up to $102. Oh, I'm sorry, they IPO'd at wait, where did they IPO at? Okay, it was at $20. I'm not wrong. It took many years, but they eventually got up to $100. They crashed during COVID and then recovered rapidly, back up to 110, and then they fell again. But this was mainly just because of supply chain issues. Now they've fixed the supply chain issues. They've got their own distribution system. They've got distribution centers, trucks, and access to cheap goods. They got all sorts of good things going for them. And they're a small float, and they're heavily shorted. So there's a chance for a short squeeze here. It's not like a ridiculous short squeeze, but there's like 12% short interest on this last time I checked. But yeah, that pretty much sums up everything that I've been looking at. I'll hang out with you guys for a little bit after market close. We're about ready to close here in just a little bit. We've got 40 seconds left in the market. So if you guys want to get into some positions, what country does Ollie buy from? I don't know where all they buy from, but I think they get most of their products in the United States. They just get them from wholesalers that have too much product in inventory that they need to dispose of. So they buy it in bulk to stock their stores, and then they give huge discounts on it. They're able to pass those discounts off to their customers. They also just added like 60 stores nationally. So they have a huge number of stores now. They've been growing so fast. Other things that I'll be looking to buy are solar and energy stocks not tied to oil. Biden is going to attack the oil industry. I'm staying the fuck away from oil. I'm going to stick with solar, clean energy, electric vehicles that are viable. It's important that they're viable companies, because any company that needs to refinance in this high inflation environment is going to get absolutely reamed on interest rates. Long-term debt is going to be very, very, very expensive. So just keep that in mind. I would say be very careful of investing in an EV company that doesn't have a very clear and short road to profit. Is there a fight going on in my chat? Ding, ding, ding. That's the bell. Sorry, I'm a minute late. The Ford dividend. I've never been a dividend stock investor. Maybe I'll do that when I turn 50. But for right now, it's not for me. A couple of other plays that I am also looking at, just to give everybody a couple of other ones that I'm looking at for short-term swings. I was looking at the Very Good Food Company. That's VGFC. This ticker came up on my radar because of a big volume spike. They jumped up to like almost 40 cents, and then retraced rapidly. But they're trading above their 200 moving average on the 15-minute chart, and on the 1 hour chart, you have a golden cross of the 50 and the 200. So this is actually a clear sign of bullish momentum returning to the stock. And you have multiple bullish divergences and hidden bull signals on the RSI on multiple time frames. So this one looks like a good volatility play. Like I was saying, the short exempts were the big trigger on this one. Short exempts spiked massively on the 25th of May and on the 8th of June, and those both signaled to me that that this thing was in for a wild ride. The on loan shares have been rising on this one, and it's not that different from Redbox or Mullen or GMVD. All of these companies have this one thing in common, is that they started off with this large amount of short interest, but what was more interesting were these huge spikes in short exempts that led to a huge sum of shares held on loan. So I'll pull up my Ortex so that we can talk about this as well. But let's look at Redbox, for example. Like Redbox is a perfect example of when this happened. So let's go ahead and take away the failures to deliver. Let's take away all of that. We'll just look at short interest and we'll look at the on loan. So we're going to focus on this time period before Redbox really gained a bunch of momentum. So all through this period from late February to mid-March, Redbox was having these volatility spikes where volume was coming in. And especially on the 18th of March, there was this big jump in price, and it wasn't really explained, but the short exempts tell a much clearer story. So if I add the short exempts to this, which huge shout out to Ortex for adding this to their charts. This is awesome. Back here, you had short exempts that exceeded 676.8 thousand back in the beginning of February, and it was a big, big red candle. And then you had big spikes in volume and shares and price action coinciding with short exempt volume spiking as well. And these signals repeat themselves in several of these plays where there's hardly any short interest in the beginning. In Redbox's case, there was quite a lot of short interest to begin with, but for Mullen, that wasn't the case. And what happens is the on loan shares rise rapidly, faster than the short interest, and then all of a sudden the short interest catches up to the on loan. And then the price will take a dip. They'll pull the rug on everybody. And in the market maker's eyes, they're able to pull that liquidity out of the market. They're able to fleece retail, and they make their profit off of all the transactions and the spread. And they don't really care what direction it goes in as long as they're able to deliver on all their failures to deliver and locate the shares for the short exempts that they took out. But if that doesn't happen, like what happened with Redbox, retail keeps buying and they keep having to hold these shares on loan, it creates a situation where the market makers kind of back themselves into a corner where they have to keep delivering on all of these transactions. They have to keep giving shares, and they're basically all IOUs. They're not shares that truly exist. We can confirm this with an actual statement from the horse's mouth, the CEO of Virtue, who went on CNBC and stated that they can provide infinite liquidity, which just absolutely floors me that he actually said this on national TV. But the guy actually admitted that infinite liquidity is what they provide, and he laughed and said, like, who else is going to do that? The government can't get rid of us. Who else is going to provide that liquidity? The liquidity fairy? Nobody should provide it. That's the answer. Nobody should fucking provide it. It doesn't exist. Those shares, the size improvement, the price improvement shouldn't happen because it doesn't exist. You're creating liquidity out of thin air. Hence, it's not real. It's not liquidity. It's a lie. It's a farce. And they backed themselves into this corner with Redbox, and they got absolutely hammered. But now they're trying to pull the rug on retail again. And they are going to pull the rug on Redbox. I'm sorry. Like, if you're in on Redbox still, I tried to be as clear without sowing fear as possible, which is really hard to do. It's a very hard line to walk. But Redbox, I saw this rug pull coming, and I'm sorry if you still were holding positions, but I think Redbox is going to keep coming down for a little while. There's a possibility that it can go again, but it's going to take retail buying the dip one more time, and it's going to have to be at a strategic level that the market maker can drive it to, but retail has to hold off buying the dip until the right time where where they can actually drive that price action back to its original location above $10 and get the market maker back into a losing position. The institutions and the market makers are the ones that are doing this right now. They bought a whole bunch of deep in the money calls. They got all of those shares. They exercised those calls to get a huge basket of shares, and they dumped them hard yesterday. They dumped them hard yesterday and in pre-market today. They did this strategically. I said it was going to happen, and I am sorry I didn't do it myself. I didn't have a position. I wasn't bearish on the stock. It wasn't anything like that. I've seen this happen so many times, and I wanted to warn people because I hate when I see people get the rug pulled out from under them. It happened to me on AMC, SPRT, BBIG, Progenity, all of these stocks that I have called out excellent squeeze plays on. I got caught up in the rug pull too. I've been there, and I'm really sorry to everybody who got the rug pulled out from under them this week too. It really sucks, and I feel for you. But if we can learn to spot these trends, this is how we win. So I'm going to do a dedicated video to that entire concept of spotting a rug pull, and I'm going to help retail figure this shit out. We're going to figure this out because there are clear signals when these rug pulls are coming. There are very clear signals. It helps to have good indicators and to understand the concepts that will help you predict these movements. Wow, we got 267 people in here. Man, thank you guys so much. Tell you what, if you're liking the stream, if you've been enjoying this whole time, that means that you should probably like the stream. So I'd appreciate a thumbs up from you. And if you like, please subscribe to the channel and give us a share on social media. Also, we have these conversations every day. We don't stream every day, but we do have these conversations every single day in the Discord. So please consider joining us in the Discord at Hell's Trading Floor. You can join us by going to our Patreon page at patreon.com/thedevilsbroker, or you can find the link to that through our actual Discord, which is at discord.gg/Hell's Trading Floor. As well, we also have discounts on several data providers such as Ortex, who we partner with. Along with we have affiliate links with Ortex, TradingView, Unusual Whales, and Tiblio. So if you're interested in getting access to any of that stuff, in addition to our proprietary Scourge bot, which helps us call out these squeeze plays and these massive over leveraged market makers, you can get access to that all through our Discord. So please consider it. Chat with some of our members. We're happy to welcome any new members to join us. And whether we're making money or losing money together, we're always having a good time. Together. Okay. So let's, Prague, is that Biora now? Yes. Prague changed their ticker to Biora.
Prague-Bora.
Prague-Bora. Let's actually catch up with Biora because I know it's way down right now. Yep, $56. I was expecting this to become a double bottom. It didn't. It broke down. So I'm still waiting. I haven't bought any more just yet. I'm waiting. But I'm still bullish on this company. I'm holding off. This is the time for patience. This is the time for patience. It's an excellent time to consider selling those out the money puts if you want to get more shares, or selling deep out the money covered calls for nearby time frames. Collect a little bit of income. I know it's like way oversold right now, but this is a good time to start collecting some income on this thing, because it's taking a while. If the company comes out with some good news and they're able to prove that they're ready to go and start manufacturing a product that they can bring out to market, then Biora will turn around. I have absolute faith that this company will be successful. I'm very bullish on this company. I'm probably a bit too leveraged on this company. I'm probably too bullish on this company. So, take what I say with a grain of salt, and always do your own due diligence. But man, just look at this OBV. Look at how many people bought this thing and held on to it throughout this entire time period. I'm just saying, I don't see the bear case. This company is holding on to tens of millions of dollars just in intellectual property rights alone. Their patents are worth tens of millions of dollars. And once they actually go to market with a product, the product itself will be able to expose them to a $300 billion market through Humira. So, I'm just saying. But we're not looking for long plays right now. Biora is still getting hurt by the market overall. I really think that has the biggest, that's probably the biggest factor working against Biora, is that the entire market right now is very unhealthy. So it's going to hurt them in the near term while the market is crashing. Nobody's really going to be looking to invest long in a company like this while, excuse me, while it's going through this period, trying to get a product out the door and into the hands of a manufacturer. But they are setting up for it. They've got all the right people in place. It's just taking time to get all of the clinical data completed. I have complete faith that Biora will be profitable in the near term. Okay, let's go ahead and check out some other tickers. I see requests for MMAT. I was actually looking at MMAT not too long ago. So right now, ooh, that's nice. All right. So I see a hidden bull forming on the RSI, and you have two bullish divergences on the RSI and the daily way back here from January and March. So they've been hitting this bottom at $1.40 repeatedly. They just broke below and bounced off of that level. Let's take a look at this on the hourly and go get some indicators up. So I'm going to put up my moving averages, and I'm also going to put up a, see, I got my VWAP, and I think that's all I need right now. Yes, yes, yes. Very good. Okay, so big bullish divergence. This is a big one. So you have a lower low in the price starting here, 9th of June, and after hours, 13th of June, and the higher high on the RSI here. So this move to the downside here was just so that they could buy up a bunch of shares and cover through a bunch of retail stop losses. Anybody who got caught up in a stop loss hunt down here, I've been studying this for a while, and for this I'll probably need to throw up another indicator here. Yeah, so this is a concept called liquidity hunting that I've been looking into and trying to study extensively. It's taken me quite a bit of time to figure this out, but what I noticed was that market makers and institutions, they have access to see our stop orders, right? So you have a bunch of retail investors that are looking to profit off of the small moves here, on a daily time frame or maybe even a 15-minute time frame, scalping trades. And these day traders, all of their orders are in full visibility to market makers and brokers. So these market makers and brokers that are in need of shares, or they want to take a big short position on something, they use those stop orders in order to fill their own orders. So you have these situations where you've got these areas of symmetrical structure, like right here. you see the price bounced off of this area at the top, and the price also had consolidation down here. So in these areas where the price is moving in a symmetrical range, it bounces off of these areas, and what the market makers do is they'll let it bounce around for a while, and they'll let the orders, the stop orders, accumulate until it's big enough to fill their own order. And what they'll do is they'll drive the price through those areas just as day traders see it as a support or resistance, and then they take a trade to, in this case, the downside. Like you see that if you see that the trend is going down, the trend was going up for a little while and it bounced off of this area and now it broke through, right? So day traders will trade that momentum. They'll see this bounce off of here and then they'll take a short and then they'll go down with the market. And then it'll hit this bottom and they'll see it consolidate and then they'll get confirmation. So they'll take a long position. They'll switch back long and take it in the other direction. And then you have these situations here where it'll start to show support. And the impatient ones, the inexperienced day traders and swing traders, they'll create a stop order just as they think that the trade is about to go in the other direction. So they take a short. And then what the market maker does is once they have enough of those stop orders lined up, they throw the price all the way through all those stop orders. They trigger them all, they take the trade, and then they accumulate a big short position and then drive it in the other direction. And this is the result. They carry it down over the next several weeks. And then they can do the same thing in the opposite direction. Once it breaks through a area of significant support here, such as the $1.40 for MMAT, they see it consolidating here. So they take it all the way down after hours and they force it to open below this level the next day. And anybody who had a stop here below 140 got triggered. And then those orders carried the price up to the next level and helped fill a long order for a market maker or an institution. Oh man, is my video quality really that bad? Oh my god. Thank you for calling that out. I'm going to go ahead and see if I can fix this. It's not allowing me to stream at that level for some reason. I'm going to have to try and drop my bitrate to see if I can get that quality up a little bit. I'm sorry that the stream quality is so bad. I'll see if that fixes it. I apologize. Okay. Well, anyway, like I was saying, all these stop orders that were waiting down here for MMAT got filled or triggered, and the market maker got filled. Or at least that's what I suspect happened. If you want to see these levels a little bit more easily, what you're basically looking for is symmetrical market structure, and you're looking for these areas of resistance and support, and wherever these levels sit at, anywhere you see the price hesitate, you can imagine a big pool of orders on both sides of that. So as you'll find out if you go all the way back in time to MMAT, this was also an area where a bunch of orders were. So you can imagine that price area is significant again here. And if you draw another one here, you'll see that this price area was also significant. And when they dipped the price down to this level, they scooped up a bunch of orders and carried it in the opposite direction. Or perhaps they are about to. That's what we are speculating on. So this big area, this what we would call a liquidity pool, helped to fill the market maker's order. Yeah, sorry guys. I am streaming at the highest quality and the highest bit rate that I can reasonably do. If you're still getting bad quality, I do apologize. But at this point, I don't think that there's anything more that I can do for it. All looks good. Okay. Well, everybody else is telling me that my stream settings are looking good. It looks fuzzy on my end, but maybe that's just because it's reducing quality for my screen. Okay. Anyhow, yeah, MMAT, it does look like it's setting up for a bounce here. This is a pretty significant price level, and it's consolidating nicely. So what I would be looking for is another bullish divergence. I would like to see the price drop back down into this level one more time and set the RSI up on another bullish divergence. If you see a higher low on the RSI and a lower low in the price, then that would be the confirmation. I'm betting that we see a move tomorrow, though. The volume is picking up nicely. Right here was a good signal. So I'll keep an eye on this one. MMAT is one of the original squeeze plays from the great meme squeeze era. I'm not currently playing Mullen. I do have some calls for like $2, but I'm only holding them because they're worthless. Right now, Mullen is consolidating, and it's been in consolidation for a while. It took a while for it to come out of consolidation during its first big move. Did it really? Oh, I'm looking at I'm looking at back before it was Mullen. That's the wrong timeline to be looking at. We should only be looking at this area. So Mullen is kind of doing the same thing that it was doing back in February through May. Let's see. So we had a big leg up after it had hit a bottom, and then it consolidated, and then made its next leg up again. So we have a large wave, a bounce, and a second wave, third wave, fourth wave. So it's forming an Elliott wave pattern, actually, or at least it looks like an impulse wave to me. Low, high, low, high. Normally it would be another low and high. But this was a much clearer impulse wave pattern. Low, high, low, high, low, high, right? And then after that, you have the correction pattern. High, low, high, low. So I'd be looking for another pattern like this again. And it does look to be forming one. You see, you have this big dip into this area down here, down to 75 cents, and then a large move up and a move back to the downside. This area of support is the significant area, just below $1. So I think that Mullen actually could turn around, but you need some confirmation. So what I'll be looking for, let's see. Let's go look for some confluences on this trade. You have a bullish divergence here on the hourly, but this was from the original move to the downside. And then you have a hidden bull from this bottom, this low to this higher low. So now we're looking for, let's see. Okay. This is almost almost a bullish divergence. Oh no, wait. Nope, 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 sorry, wrong. This would be bearish divergence. All right, that doesn't look good. That doesn't look like a valid confluence. Let's see, we have our bullish divergence here. We have a hidden bull here. I'm just looking for any commonalities in the RSI and okay. I think I got it. So the big impulse move on Mullen that started this thing off, it triggered a move up to $2 and then came back down hard. It gave the price enough lift to cross the 50 above the 100 daily moving average. Or this is the hourly, sorry, the 50 and the 100 period moving average on the hourly. The next impulse move came after the 50 approached but never crossed the 100 and bounced again. So now we have the 50 on approach to the 100. It hasn't quite crossed, but it looks like it's about to. Let's see if MACD can tell us anything. This could be something. We have an impulse wave and a cross below, and it stays below. Crosses up, crosses down, crosses up again. And then you have that Elliott wave pattern. So let's see, do we have something similar happening here? We do. So we have long consolidation during which the entire time, this entire period, the MACD is trading below the signal. You get an impulse wave and a cross back down and consolidation where the MACD trades below the signal again, and now it's making another cross. So at this point, I'd be looking for some confirmation. They drove the price down to $1. I'm just looking for any other signals that would tell us. Yeah, this price level at $1 is significant. Okay, I see two possibilities. On one hand, I see the price consolidating and then suddenly the MACD cross and additional crosses of the moving averages sends the price up naturally. Or I see a scenario where the price is forced back down below $1 until it touches this area where there's a liquidity pool here. And I feel like this is the more likely scenario. So I would expect if there is going to be another launch in Mullen, it's going to have to drop down and touch these areas first. There's a lot of short interest in Mullen still, isn't there? I'll go confirm that. Still quite a bit of short interest. What is the on loan like? Very high. Utilization's maxed out since when? Okay, May 24th. All right, Mullen's going to trade down for a little while. That's what I'm seeing. I'm seeing that it's going to trade down for a little while, but I will go bullish on it again once it crosses below 95 cents. That is an area of demand. I'm calling that out specifically because there's past price action to corroborate this. First time, Mullen had an easy time crossing below into that area, and it dipped down into this lowest point, down where it hit like, what was this? It was 65 cents. Or I'm sorry, 76 cents. Yeah. There's a big spike that signals the impulse move. So I am willing to bet that what you will see is a huge drop down to this area. If it crosses below 95 cents to 92 cents or any lower than that, I think it'll find huge buyers. The MACD will have to cross down below it one more time, and then it can act like a springboard and launch the price in the opposite direction, at which point this could be the next impulse move. This is entirely based off of supply and demand technical patterns. It is not something that I have researched thoroughly enough, nor do I have significant experience trading this strategy. This is an experiment. I strongly recommend that everybody who's listening that's considering this, please do your own research. Take the time to learn this on your own, and don't just trust my word on it. For right now, I'm staying out of Mullen. I'm going to hold off on it. If I see it cross below this level into this demand zone, then I will buy. If I see it cross above the 200 period moving average, I will also treat that as a buy signal. Okay? So I'm going to go ahead and set some alerts and give this to our professionals. If you want to get access to these alerts, you can join us at Hell's Trading Floor. All members of the professional tier have access to these alerts. And I am going to be doing these. Alerts more frequently again. I've been kind of being a little bit lazy lately, so apologize, guys. But I had to take care of quite a few things at home and abroad. So I hope you'll forgive me. Okay. Okay. So I've got that trigger, and I'm also going to set this trigger up as well. Need to do an alert on the 200 moving average. Hey, Marcus, I already covered Biora. If you want to go back in the stream a little bit ago, my initial impression is to just hold off because I think that there's a little bit more downside left in it. Um, I will be waiting for confirmation and some bullish news to trigger any buys in the stock. Uh, I can't say your name on stream, but thoughts on Weber? Sure, I can do that. Weber grills. I used to have a Weber grill. I love cooking on grills. I still do. Okay. All right. So we've got some big consolidation. I like this. There's liquidity pools down here at these price levels. If I'm not mistaken, there was also some short interest in this one too. Not a ton, but still some. Let's see. Weber. Oh, what the hell? 52%. Where did that come from? That wasn't there a few days ago. I did look at this before. It wasn't there before. Holy smokes. Okay.
Similar thing popped up on Revlon. That was one of the first things I saw, and then we got the halt alert through the bot. And then there was news of a Chapter 11 potential filing, and it tanked.
Ooh.
And then there was a bounce.
See, Chapter 11's weird because everybody expects that to mean the death of the company, and in actuality, that rarely means that. If anything, a Chapter 11 means that the company is going to figure out a financing deal to get some of its debt relieved, and they can get a chance at a preferred payoff. But the problem is that it forces them to liquidate certain assets. But they can get protection from debt collectors temporarily, enough that they can protect their assets necessary to continue doing business. Let's see. All right, so this is interesting. All right, utilization. Wow, this has been maxed out for how long? Okay. All right. I see some potential here. I see some potential. Bro. What is this all about? They did a dividend announcement. It gapped down and bounced. Ex-dividend date. Okay. Wow. Since February 10th. February 9th. Interesting. Let me look for this short exempts. I want to know what short exempts look like on this. I'm going to go full screen. It's almost non-existent. Interesting. There's almost no short exempts on this. Well, Weber is definitely being targeted. Where are they getting these shares from? Wow, that's wild. That is wild. Okay. I will be paying close attention to this. It's not on the threshold list. Failures to deliver did spike pretty heavily back in February, so that can happen again here. I'm going to be looking for the on loan to start accumulating pretty rapidly. I'm betting we start seeing short exempt spikes in this as the price trickles down a little bit further. I would say be patient with this one, but we can set some triggers and see if we can catch this on a bounce. Okay. Then I need to do an alert on this as well. I want to see the 50 cross above the 200. And that will be by confirmation. It's still crossing down, so it's not in great shape. I'm gonna say patience is key here, because they're being targeted. I don't know if it's by a massive institution or if it's just like general bearishness on the company overall. And I don't know what their financial status is. We'll have to do some DD on this one separately. Their net income is not that great this year. But it could still turn around. We will see. We will see. Let me catch up with chat again. Jeff Miller, no, I don't think that Biora is toast. I'm invested in that company for a very long time. I have leaps and a lot of shares in that company that I intend to hold forever. I don't have a retirement account, but if I did, I may as well have them in there. I plan on never getting rid of them. It's a growth stock for my lifetime. City Blades, thank you for the dollar. I appreciate that. The F500 news getting added to the Russell 2 and 3000. Oh, you're talking about Mullen. Yeah, being added to the Russell is good for them. I could see that being helpful for their stock. But it doesn't mean that it will turn around out of nowhere. DBGI oversold. I'll take a look at it. I'm running out of time. I'm going to have to go get some coffee and get ready for a work meeting at 2 o'clock Pacific. So I got to catch that. Well, you got a cross of the 50 above the 200 on the 30-minute. You got a cross of the 50 over the 100 on the 1 hour. And on the 2 hour, they're still really, really, really far away. I don't know what happened to this company, but
tell us what they did to you.
Wow. Wow.
Tell us where they hurt you.
Wow, what mob boss did you guys upset? Did you guys like stiff Kevin Griffin on a cashmere sweater or something?
Oh, Kenny boy. He loves his cashmere. He does.
All right. Well, I would be really, really cautious with this one. But if one of the analysts would kindly just go ahead and post the inspect from ScourgeBot, that would give me a hand. I want to keep moving forward. All in on SPY 300 put leaps. If anything, I would go for like the 380s and just hold those. I know that that's really expensive, but they can be very valuable. Did I talk about GMVD? I did not, actually. I meant to do that. So I'll go ahead and jump into GMVD. So GMVD is actually quite interesting. This company is going after naked shorts, apparently. This is mostly research done by Hoot Money, who asked me to take a look at this. And I do see several confluences that confirm a move to the upside. There's multiple bullish divergences on the daily and the hourly timeframes. What really signaled The next move to me, however, was a huge spike in short exempts. So I'm going to go ahead and pull my charts in here. Where are you? Come on, come on, come on. I was doing a ton of research last night, so I'm having to scroll all the way back into my history. I'll just do it again. I'm happy to say that ScourgeBot is getting a huge update this week. We got access to a really, really nice data provider. It was expensive, but it was worth it. Totally worth it. And now we're going to be able to run our inspects in about 5 seconds or less. Instant gratification on short exempt data.
Gonna be awesome.
Yeah, it normally takes like 10 minutes to run certain inspects because they're so large and it has to get the data manually. But now, no longer so. Okay, you're gonna love this. So, so this company was trading at sub 80 cents for some time. After it fell below $1, it was hovering around 80 to 70 and 60 cents. And it's just been slowly going lower and lower and lower. And you'll notice that in all of this time, the short exempts were pretty much non-existent. This is a normal level for short exempts because it's an illiquid stock. It's very thinly traded. So you see a few thousand. 10,000 is a bit of an anomaly, but like still, you only see that once, so it's not that significant. So all this history as the price is going down, you see that as, you would interpret that as normal price action and normal short selling volume. Even if it may be malicious, we don't know, but this is an anomaly right here. Massive spike, 373,000 short exempts on a stock that only has a float of what? Let me go ahead and pull up our fancy schmancy new. Oh, whoops, wrong one. GMVD. I gotta pull up my data. So their free float is only 18.5 million. Their total outstanding shares is 24.4 million. So the short volume in this stock was, let's go ahead and break out the calculator. Short exempt volume divided by their outstanding shares. This short exempt day today was 2% of their total outstanding shares was short exempted. If you were to take that out of the float instead, 501,748 divided by their float of 185,01677, so 18.5 million roughly. Multiply that number by 100, you get 2.7%. So 2.7% of their entire free float was short exempted today, and the day before an additional, I'm going to say about 1.8%, just with a little rough head math, was short exempted the day before. Now, the day before, the price had collapsed from a high of 75 cents down to 34.5 cents where it closed. This is market makers fucking with shit. The short exempt ratio here, which is the short exempt volume divided by short volume, you can see that the massive majority of these shorts were all short exempt. So all of this short volume, I promise you, is mostly the result of market makers and broker dealers that are fucking with the price. These guys are trying to negotiate to get shares at a better price. If retail denies them, then you can actually put them in a position where they must reaccumulate inventory at market price. They will need to borrow stock at a much, much more expensive level, and it will cost them. So this is what retail can do to go and fuck with a market maker and make a little money. So first things first, I want everybody to go ahead and write this down and take note of this data. You have a huge spike in short exempt volume. One thing you need to know, short exempts can be failures to deliver. After 6 days, if a short exempt is not located and it fails to deliver, it must be returned. It can be returned with either a purchased or a borrowed stock. What this correlates to, which you can confirm with Ortex data, notice that the short interest of free float is tiny. Teeny, teeny, tiny. There is no short interest to speak of. This is not true because you can look at the on loan and you can see that the on loan shares is 1.18 million, more than almost 10 times what this current level is. So in actuality, these on loan shares, I'm betting you most of these shares on loan are actually being loaned out by a market maker so that they can cover those short exempts because they needed to locate them. Now, those short exempts, if they do not cover these at a preferred price, meaning if they don't get it for a lower price than what they short exempted it at, then those will fail to deliver. In 4 days, without locating the share, those short exempts become a failure to deliver. So after the 6th day, they must deliver that by market open. So take note of these levels, 373,000 and 501.7 thousand shares. Not all of them, but many of them are likely fails to locate. So these will become failures to deliver after 4 days, and then they must close those after T plus 6 days. So expect that by next Wednesday or Thursday, there will be some significant price action. Here's the thing. If the price is already higher than where the market maker received these shares from short exempting, or I'm sorry, let me correct that. If the market maker is looking at a market price that is significantly higher than where it marked these short exempts at, somewhere below 75 cents, it has to be below 75 cents. If the price goes higher than this level, then they are put in a very serious situation where they must cover those shares at a higher price, which is going to cost them. Although they would like to have you believe that they are the liquidity fairy, they are not. They do have limited money, and they do need to deliver this stock somehow. So this is a situation, just like with Mullen and Redbox, where this stock can also make a huge move because these short exempts must be delivered after a certain period of time. What they are likely to do, write this down also, they are likely to borrow these stocks from someone else, and then they will wait. They will borrow them and they will wait, and they will try to drive the price down again. When they try, if retail buys again, then the price lifts more. They short exempt more. They try to drive the price down again and fail. They must borrow more, and the cycle continues. They'll do this 2 to 3 more times. After that point, you see the on loan skyrocket. The short interest will go from 0.9% to over 15 to 20%, or maybe even higher than that. By the time they are done over leveraging themselves in this cycle, they are going to see the price going above $2 to $3. And that's when they start adding options in because they have to. When they add the options in, they're going to use that liquidity against you. They're going to drive the price down. So do the smart thing. If you have shares, you can sell covered calls and anticipate that move to the downside. Worst case scenario, you get assigned on those calls. You sell them at $3 or whatever dollars you sell the for whatever strike price, and you make money. Don't be upset about that, because that means that the market maker would just be honoring their duty to make the market, and you would be getting assigned based on a price that you agree to sell your shares for. Which at this point, if it goes to $2, $3, $4, and you sell a covered call for any of those ranges and you get assigned, then you would be making anywhere from a 300 to a 600% profit. So you can't be upset. The alternative is they drive the price back down. You take the money from those covered calls that you sold, buy more shares, hurt them a little bit more, and the price continues going up, and then you tell them try again. And we laugh. And this is how retail can continuously milk the system and fuck the market makers because they're too busy fucking with the system and they think that they're outsmarting us, but we're getting smarter. So, some important things to take note of. In order for this to work, the majority of retail needs to be purchasing directly from the exchanges. So if you're on a broker that allows you to direct your orders to the exchanges or routing your orders to the exchanges, it's important that you do this. Routing to the exchanges, whether it's NASDAQ or NYSE or IEX, any of those are acceptable. They are slow. They do take time to fill. You may not get the best fill, but you will be denying liquidity to the market maker. You prevent the market maker from being able to route your orders internally and filling the orders through a wholesaler or an internalizer system, which goes to a dark pool. And that's how they fuck with this thing. They fuck with the price action by sending your shares, your orders through dark pools. Once it gets there, they fill the orders in one big bulk order, and it has very little effect on the price action. If you send all of your orders to the exchanges, whether it's 1 share, 10 shares, 100 shares, or 1,000 shares, doesn't matter. As long as it's going to the exchange will see it, and the exchange's algorithms will react accordingly. If they see the buying volume going in that direction, it will help move the price in the correct direction. It does help with price discovery, so it's important. I'm afraid that I am all out of time, but I hope that everybody got something out of this. I'm going to clip this into a separate video so that everybody can get this explanation and everybody can understand how this whole thing works. It's a lot of fuckery. It's a lot of shenanigans, and I understand it's difficult to grasp, but all of this can be learned and it is available. And if you want to ask questions, please come join us in Hell's Trading Floor. I promise there is no stupid questions here. This is an extremely complicated system to understand. We will help you understand it. We will help educate retail, and we will figure it out together. And we're going to make ourselves fucking rich while we do it. That's going to be it for me, guys. Thank you guys so much for coming to join me on this live stream, and I'll look forward to seeing you again. In the meanwhile, have a hell of a time in the markets.